All right, welcome to the Explainer. Today we're diving into a really detailed financial report. It's looking at the state of global markets right now, as of February 24th, 2026, and it's making some pretty bold predictions about what's coming next.
So if you just glance at the markets, everything looks absolutely fantastic. US markets are hitting all-time highs pretty much across the board. And it's all being pushed by this one really powerful story. AI is changing everything, creating unbelievable growth, and everybody wants a piece of the action. But, that's just the surface.
And that's where the report we're looking at today comes in. It asks a totally different and, frankly, a much more important question. Is all this record-breaking strength actually built on solid ground? Or is it maybe just an illusion, hiding some deep structural risks that are just waiting to crack? So to get to the bottom of that, we're going to walk through the report's entire analysis step by step. First, we'll look at the hidden risks it's flagging. Then we'll talk about the tipping point, that moment when all this optimism could flip to fear. After that, we'll explore what that means for the rest of the world, and finally, look at the new economic reality this report says is right around the corner. Okay, so where are the weak spots? The report doesn't just talk in generalities, it pinpoints 4 specific, really critical pressure points that are seriously challenging all this market optimism. First up is crowd psychology. The report makes a pretty bold claim here. It says this whole AI frenzy isn't really being driven by rational spreadsheets and valuation models. It's being driven by something it calls social mood. And that mood, well, it's starting to change. A big catalyst was a recent report from Citrini Research, which started warning about a future intelligence crisis. That's begun to shift the collective feeling from just blind optimism towards, a creeping sense of fear. The second pressure point is this really fascinating concept the report calls ghost GDP. And this isn't just about losing jobs. It's about a fundamental break between what the official numbers are telling us and what's actually happening to real people.
This visualizes that economic paradox perfectly. Okay, step 1. AI makes companies way more efficient, so the top-line GDP numbers look fantastic. But step 2, that same efficiency starts displacing human workers, which leads to step 3, consumer spending power starts to collapse. The end result, the real economy, the one where people actually buy stuff, it actually shrinks, even while the official GDP figures are soaring. It's phantom growth.
The third crock is all about history. We've seen tech booms before, and they tend to follow a pattern. As this quote from the legendary investor Bill Gross makes really clear, some of the smartest money out there is already signaling that the valuation cycle for the biggest tech stocks, what he calls the Elite 8, has probably hit its peak. And that means it's due for a major correction.
And the fourth and final crack, well, this one is a really big deal. It's a massive geopolitical policy shift. The activation of the 1974 Trade Act has put a new 10% global tariff in place. Now, this isn't some minor tweak. It fundamentally rewrites the rules of global trade, it bakes inflation into the system, and it destabilizes the entire free trade framework that markets have depended on for decades.
Okay, so you've got these 4 cracks spreading through the foundation. The big question is, how and when does the whole thing start to crumble? Well, the report pinpoints the second half of this year, 2026, as the moment the entire story completely flips, when that social mood shifts from just unchecked optimism to widespread fear. And this just illustrates that predicted shift perfectly. The first half of the year, it's all about AI optimism, efficiency, cheap money. But by the second half, the report forecasts a totally different reality. The market's going to be gripped by the fear of a bubble bursting as the real-world impact of that ghost GDP starts to hit home. Capital costs go up, and that massive river of B2B software spending that fueled this whole boom just suddenly dries up. Now, this isn't just a story or some gut feeling. The report's quantitative models actually back this up. This is a Garch volatility model, and it basically measures how sensitive markets are to shocks. And look at the NASDAQ, the home of big tech. It shows extreme sensitivity to short-term shocks and very high persistence of long-term volatility. In plain English, that means the market isn't just fragile, it's practically designed for any small shock to set off a long and intense period of chaos. So what does a bursting AI bubble combined with this new era of tariffs actually mean for financial markets around the world? Well, according to this analysis, the fallout is going to be widespread, it's going to be severe, and it's going to have ripple effects pretty much everywhere. For the United States, the report forecasts a really painful stagflationary trough. That toxic mix of stagnant growth and high inflation. It basically traps the Federal Reserve, making it almost impossible to cut interest rates.
We'd see a violent rotation in the stock market out of those big tech names and into safer, defensive sectors like energy. And the private credit market could face a wave of defaults, starting with all those tech-backed loans.
Hopping over the Atlantic, the outlook for Europe and the UK is pretty grim. The analysis points to a manufacturing-led recession, which gets even worse thanks to those new U.S. tariffs. This forces their central banks into a corner, having to cut rates even as their economies are slowing down, which just creates this doom loop of weaker currencies and rising geopolitical stress. And all that stress, in turn, funnels investment into one of the few growth areas left: regional defense.
The forecast for China and Hong Kong is basically one of being stuck. The report argues that no amount of government stimulus can overcome the two big headwinds they're facing: U.S. tariffs and their own ongoing property crisis. And Hong Kong, well, it gets caught right in the middle, becoming a major casualty of the tech war as foreign money flees, sending its main index sharply lower. The report saves a particularly stark warning for South Korea. Recent data has shown that its whole export-led model is under serious threat from China's growing dominance in advanced manufacturing. So as that global AI investment boom starts to peak, South Korea's heavy reliance on semiconductor exports turns into a massive vulnerability, threatening a pretty sharp market correction. So you take all these different global pressures, you mix them all together, and what's the one clear winner in the currency markets? A structural return of the strong dollar. As risk goes up around the world, investors are going to flee to the perceived safety of the US dollar, causing it to strengthen against pretty much every other major currency out there. So, after all of that, what's the ultimate takeaway from this comprehensive and, let's be honest, pretty sobering analysis? It's that the entire investment paradigm we've gotten used to for years is going through a fundamental and probably pretty painful shift. The core message really couldn't be any clearer. The strategy has to pivot from offense to defense. It's not about chasing the last little bit of growth from a fading boom anymore. Instead, the focus has to shift to preserving your capital. Basically, to surviving what the support predicts is going to be a major economic contraction.
And this leaves us with one final and I think really provocative thought about what comes next. As the dust settles from this huge AI paradigm shift, the rules for how you create value are going to change. And it forces us to ask a really tough question. In a world that's going to start demanding real, tangible value, not ghost value, which economies and which industries are actually going to prove to be the most resilient?